Welcome to the Deep Dive, the place where we take the stacks of sources you send us, the articles, the notes, the internal memos, and turn them into immediately useful, high-impact knowledge.
Today we're going behind the curtain of private equity fund management, and we're not talking about the flashy deal makers.
No, not at all. We're focused on the disciplined, meticulous finance professionals who handle the actual cash, the people
Yeah.
who manage the accounting for these multi-billion-dollar funds.
And our source material for this is just fantastic. It's basically a roadmap to the technical knowledge you'd need for a high-level PE fund accounting role.
It's a real shortcut to understanding how billions of dollars get tracked, valued, and, eventually paid out.
And you can feel the intensity right from the job requirements. It mentions a U.S. shift, which means late nights,
Right.
because you need that real-time exposure to these incredibly complex U.S.-based fund structures. This is not some 9-to-5 bookkeeping job. It's high-stakes financial mechanics on a very tight schedule.
So our mission today is pretty clear. We're going to pull out the four core pillars of this world. We'll break down how they value things, how money actually flows, how they split the profits, the infamous waterfall, and finally, what controls they use to make sure it's all done right.
Yeah, the safeguards.
Okay, let's unpack this. Let's start with the big one, the ultimate scorecard. Net asset value, or NAV. How do you even begin to value a fund full of private companies? You can't just look up on a stock ticker.
Well, the basic formula is simple on the surface, right? NAV is just assets minus liabilities. But in private equity, the whole challenge is in the application.
Because the assets are illiquid.
Exactly. You can't just check a stock price, so all PE investments have to be carried at what's called fair value. The NAV is, in a way, this necessary fiction that lets the fund report its performance until an asset is actually sold.
So what are the key pieces of that calculation, specifically for PE? What's on the asset side?
Well, the biggest piece, obviously, is the investment portfolio itself at fair value. But you also have to include things like capital call receivables.
Ah, so that's the money the investors have promised but haven't actually sent yet.
Precisely. It's a legal obligation. So it's an asset because the fund is guaranteed to get it. Then on the liability side, you have your normal expenses, but the really critical one is accrued carried interest.
And that's the general partner's claim on the profits.
On the unrealized profits, it's the money they're owed if the portfolio were to be liquidated today at its current fair value. It's a huge liability.
Okay, let's make this fair value concept a bit more concrete. Our source material has a great example. A fund improves a company's EBITDA, its earnings, from $10 million to $15 million.
And that's a massive driver of NAV. Let's say the fund used a standard 10x EBITDA multiple to value it.
So a $100 million company.
Initially, yes. But by increasing that EBITDA to $15 million and keeping that same 10x multiple, the company's value on the books just jumped to $150 million. That's a $50 million unrealized gain, just like that.
Wow, and that just shows how leveraged the whole valuation is on that one internal assumption, the multiple.
It is. Which brings us to a really common question. Why do PE funds only calculate NAV quarterly when mutual funds do it every single day?
Yeah, why is that?
It's purely a resource issue. The valuation process is an incredibly deep analytical dive. It involves complex models, sometimes even third-party firms. To do that every day would be, well, impossible. The quarterly rhythm respects the amount of work involved.
Okay, so that's the scorecard. Now let's track the actual cash. When a fund needs money for a new deal, it issues a capital call. How does that get recorded?
It's a two-step dance. The moment the notice goes out, the fund has to recognize that legal promise. So they record an asset, the capital call receivable, and at the same time credit the LP's capital account.
So you've created an IOU, basically, an asset that's a promise of cash. What happens when the wire transfer actually comes through?
That's step two. The cash account goes up, and the receivable asset goes down. The promise is fulfilled, the obligation is cleared, and the real cash is in the bank.
Now let's see that cash get put to work. Say $10 million is called. The fund uses $9.5 million for the investment and the other $500,000 for management fees. How do you show those two different uses?
You have to split them. The $9.5 million becomes an investment asset. It creates potential future value. But the $500,000 is just an operating expense. It's gone. Delineating that is critical for tracking true performance.
Okay, fast forward to the best case scenario. A win. A $10 million investment gets sold for $25 million, a $15 million gain. What does the accountant do right then before anyone gets paid?
The initial entry is easy. Cash up by 25, investment asset down by 10, and you book a $15 million realized gain. But the real job starts there.
The review.
Yes. 3 crucial checks. 1, any transaction costs, legal fees, banking fees. 2, is any money being held back in escrow? And 3, the big one, any tax implications, especially foreign withholding taxes. You could only distribute the net cash.
All of this means the fund's balance sheet looks pretty different from a regular company's, right? You don't see shareholder equity.
Not at all.
Yeah.
Instead, you have partners' capital accounts. These are the heart of PE accounting. They track every single LP's position, what they've put in, their share of profits, what they've taken out. It's a totally personalized view of equity.
Here's where it gets really interesting. Once that profit is real and the cash is in the bank, we get to the distribution waterfall. The rules for splitting the pie. I understand there are 2 main types, European and American.
That's right. And they are very different. The European waterfall is what you call a whole fund model. It's very LP friendly
Why is that?
because the general partner, the GP, doesn't get any of their profit share, their carry, until the LPs have gotten back all their invested capital
Across the entire fund.
across the entire fund. Plus, they have to get their preferred return first.
Yeah.
It massively reduces the risk that the GP gets overpaid early on.
So what about the American, the deal-by-deal structure? That sounds like it's better for the GP.
It is much better. With an American waterfall, the GP can take their carry as soon as a single deal becomes profitable, even if the rest of the fund is underwater. It gets cash to the GP faster.
But wait, that seems like a huge risk for the LPs. Why would they ever agree to that?
It's all a negotiation. Some LPs might accept that risk to get into a fund with a top-tier manager who's known for quick wins. They're betting on the manager, but yes, structurally, the European model is far safer for the investor.
Let's really dig into this. The source material gives us a complex European-style calculation to walk through. This is where you see how meticulous this job is.
Okay, let's do it. So the scenario is total proceeds hit $230 million. The LPs have put in a total of $110 million. There's an 8% compounded preferred return and a 20% carry for the GP.
So the total profit is $120 million. The difference between the $230 in proceeds and the $110 they put in.
Exactly. So how do we slice up that $230 million? It happens in 4 tiers. Step 1, return of capital. First rule of the European waterfall.
Yeah.
LPs get all their money back first. So the first $110 million goes straight back to the limited partners.
Okay, simple enough. So now we have $120 million of pure profit left to distribute.
Correct. Which brings us to step 2, preferred return. The LPs now get their 8% compounded return. The sources calculate this to be $36.05 million. So that amount goes to the LPs next.
All right, so after capital back and the pref, LPs have received about $146 million. There's still roughly $84 million in profit on the table. Now the GP finally gets a piece.
Now, and this is the part that can be confusing. Step 3, the GP catch-up. The GP now gets 100% of the next dollars of profit until their share equals 20% of the total profit.
The total profit being $120 million.
Right. So 20% of that is $24 million. The GP gets the next $24 million of profit all to themselves. This catches them up to their 20% share.
So it's a mechanism to make sure that 80-20 split is maintained over the whole profit pool.
Perfectly put. Once the GP has been caught up, we can go to the final step.
Step 4, the residual split.
The remaining profit, about $60 million, is now split 80-20. 80% to the LPs, 20% to the GP. And when you add it all up, the $120 million in profit is split exactly $96 million to the LPs and $24 million to the GP. The 80-20 split holds perfectly.
That is incredibly methodical. But what about the downside? What happens if NAV goes down?
The accountant has to act immediately. They have to reverse that accrued carried interest liability we talked about. If the unrealized profits disappear, the GP's claim on them also has to disappear from the books. It's a critical control to stop the GP from being overpaid.
Okay, speaking of controls, what happens when things go wrong operationally? Say an LP just doesn't pay their capital call.
An LP default. It's a huge deal. The consequences are severe. First, they get hit with default interest, sometimes as high as 10% annually. If it continues, the fund can force them to sell their stake, dilute their interest, or in the worst case, they forfeit everything.
Wow. So what's the fundamental control that makes sure all this is tracked correctly for every single LP?
It's the LP capital account reconciliation.
Yeah.
It's a simple roll forward. For every single LP, you have to prove their beginning balance plus contributions plus profits minus distributions equals their ending balance.
Yeah.
If that equation doesn't tie out for even one LP, the books are broken.
And the sources had that great story that shows why just balancing the books isn't enough. The $2 million discrepancy.
But this is such a great operational lesson. An
Yeah.
accountant processed a new $2 million investment. They called the capital, booked the asset. Everything looked perfect on the general ledger. But the cash reconciliation showed the bank balance was $2 million too high. He dug in and found out the wire authorization form. It just failed. It never executed. The money was recorded as spent, but it never actually left the bank.
So the lesson is you have to verify execution, not just authorization. You have to check the real-world cash.
100%. Your internal books mean nothing if they don't match the reality of your bank account. That is the definition of operational risk management.
Let's touch on the metrics LPs use to judge all this. We always hear IRR and TVPI. What's the quick difference?
IRR, internal rate of return, is about speed. How fast did you make the money? TVPI, total value to paid in, is about magnitude. How much money did you make in total?
And why is TVPI often seen as more important?
Because it's so intuitive. A TVPI of 1.4x means for every dollar I gave you, I got $1.40 back in total value, period. IRR can be manipulated by quick, small wins early on. TVPI gives you the complete picture of value creation.
And lastly, what about when a portfolio company has different classes of stock, like with liquidation preferences? That must be a valuation nightmare.
It's a massive headache. If a company has Series A stock with a 2x preference and Series B with a 1x preference, you can't just value your stake based on your ownership percentage. You have to run a mini waterfall inside the company valuation just to figure out what your slice is actually worth.
So when you pull it all together, what have we learned? It seems like the core of this job is translating illiquid assets into fair value, mastering these complex waterfalls, and maintaining absolute control through rigorous reconciliations.
And our source shows the intense reality of it. You're managing 4 to 6 funds at once, maybe $500 million to $2 billion in assets, and you have to get those investor reports out exactly 45 days after the quarter ends. The pressure is immense.
But for me, the most powerful insight from all this was that final scenario where the accountants realized that even with all the complex math right, they just didn't have the cash.
Right. They calculated a perfect $20 million distribution, but there was only $5 million of actual cash in the bank. And in that moment, the job instantly changes. You stop being a mathematician and start being an operator.
You have to start suggesting solutions, selling assets, drawing on a credit line.
Exactly.
Yeah.
Just to make the distribution physically possible.
So for you, the learner, consider this. How often are the highest level financial decisions in a multi-billion-dollar world constrained not by some complex formula, but by simple, real-world cash limits? That pivot from theoretical profit to operational reality, that's what separates a good fund accountant from a truly great one. Thank you for joining us for this deep dive into the financial mechanics of private equity fund accounting. We'll see you next time.